Welcome in, folks. Got a four-piece for you here today. 4 videos for me to react to. First one up here, Palantir CEO Alex Karp with some interesting comments that I want to go ahead and react to here that I think is definitely worth addressing. Then we're going to get into this one from 4 hours ago, Ed Yardeni. Ultra dovish cuts may be off the table after CPI report. Okay, we'll get into that one. Mike Wilson, if you don't remember Mike Wilson, we used to react to Mike Wilson quite a bit on this channel back in 2022 and 2023. And the reason was Mike Wilson was incredibly bearish. Well, I haven't seen Mike Wilson for a while, right? And so he was on Bloomberg here today. Mike Wilson on the Fed, inflation, artificial intelligence. Looking forward to getting into that one. And then the man that used to be bearish way back in the day, Mr. Big Short, Steve Eisman, he also went on CNBC a few hours ago talking about what he expects the Fed to do, what he sees in the economy, all those sorts of things. So looking forward to reacting to that one. Appreciate y'all being here as always. Thank you for being subscribed. By the way, I forgot to mention, we are now over 50,000 subscribers here on the Reaction channel, so I appreciate each and every one of you for being here. It's been quite a climb over the past, I think this channel is maybe 2 years old now, so I appreciate y'all being here. Pin comment about down there today. I put together a brand new workshop for you guys. I'm already thinking about next year, 2025. Put together a brand new workshop about what stocks to buy now for 2025, how to position your portfolio. If you want that via email or text, we can send it over either way. Let's get into this. He would come in like this.
On Friday, Palantir was admitted to the S&P, which is an enormous, momentous occasion for every Palantirian. It is enormous because the way in which we built the company should have precluded membership to the most elite institution in economic life, the S&P 500. In order to be on the S&P 500, you have to be GAAP profitable, which is a financial way of saying you have to make real tendies, subtracting everything, after subtracting every form of remuneration that could possibly be included, including your well-deserved equity. And we did it. And how did we do it? We built the best products in the world. We started off in one area of the West, clandestine services. We migrated into the military, into spec ops, into U.S. commercial, and into commercial globally. And how did we do that? We built products, first PD, PG, then we built Apollo, then we built products for the spec ops, then we built Maven, then we built Foundry, then we built the Ontology.
Something very important I got to touch on here. Extremely important everybody understands this, okay? He's just running you through the product roadmap they've been on for the last, 10, 20 years, right? Listen, here's the deal. There's going to be a lot more products coming over the next 5, 10 years, and we don't see today. And that's what it's important that everybody understands whenever you're thinking about owning Palantir stock, or you own Palantir stock, or you're considering it, things like that. There's going to be growth opportunities for this company in ways that we never could foresee as of today. Okay, so that's something very important. Just like AIP is this big thing nowadays, like 3 years ago, 5 years ago, no one was thinking about that, right? You could say Foundry is this big product nowadays. Many years ago, Foundry was nothing, right? So this is just something to keep in mind.
And we then integrated that into AIP. All of these products were conceived and productized and now are being platformized, meaning we are taking them and making them the base substrate of what enterprises do, i.e., using us instead of what sometimes could be described as a monster internally that prevents the use of the most important technologies of our lifetime, i.e. AI and large language models, as an end user. And these were conceived again and productized, in some cases, a decade before anyone else even thought that you would need them, much less that the whole enterprise would turn on a platform that actually could power AI and large language models. It's still radical to the point where people do not completely comprehend. They do not comprehend how we could have turned a switch and gone to GAAP profitability and gone from what adults, professional managers, and some analysts thought was a Frankenstein monster powered by a freak show leader, me, to a dynamic, clearly profitable company worthy of and admitted to the S&P 500. And we did it our way. While everyone is now running around talking about how they should build platforms, how you should try to get Palantirians, realizing that no credible institution in commercial life can really be built without Palantir or an ex-Palantirian. We had already begun this. At the DPO, we rejected professional management. People everywhere discussing how to build companies in a way that keeps the somewhat, if not toxic, often carcinogenic influence of people who've written PowerPoints out of your company. Palantir did this naturally. Our products reflect that. Our culture reflects it. Our revenue reflects it. Our quality of revenue reflects it. And by the way, our investor class. People trying to use the term retail investor, which is another way of saying people courageous enough to invest their own money, otherwise known as tendies, in what they believe in. And look at the list of the people, our partners. I hate the term clients, but look at the list of people that use our product. The most important clandestine services, the most important special operators, the most important AI targeting work in the world, the most important allies, none of whom we're ashamed to support in private or in public. They rely on Palantir. Look at our list of commercial partners in and outside the U.S., but especially in the U.S., that use Palantir, either at Foundry, the Ontology, AIP, all the above, and are beginning, and in some cases are already using our platform as a platform. And then look at our structural advantage.
You know, the thing I love about Karp, right, is here he is. He makes a point. He'll make a point, and what's it? He always bring it back to. It never fails. What's he always bring it back to? The product, the product, the product, the product. And I just I appreciate that, and I like that about him. And yeah, man, it always ends up coming back to the product. He'll make a point, and then it's back to the product, right?
Having a company built around what you ought to build, not what you were told to build in some weird, otherwise called artistic program that's kind of academic and imposed upon you by people that have no skin on the game. We resisted that. We are going to continue to resist that, not just for our sake, but for the sake of our partners that rely on us. In any case, everybody, all of you who are inside the company and around the world should celebrate that the rebels won. The rebels won on Friday. I don't know any other occasion like this where the rebels actually got inside the gate and helped the institutions transform themselves. And there's no better metaphor for that than being admitted to the S&P 500. And while it's maybe not the most important thing, I am really, really, really happy. Because we did this together, and the future belongs to us. So let's go attack, have some fun, and celebrate a momentous occasion. Thank you.
Yeah, so, you know, he is very happy. And this is something Karp's wanted for, I mean, gosh, when's the first time he mentioned S&P 500 inclusion? It might have been 2 years ago now. Probably at least a year and a half ago. He's wanted this for quite some time. And so, yeah, I could see him being just as happy, if not happier, than probably anybody else out there, just to be quite frank with you guys, right? And I think the main reason, my personal belief is the main reason he's really wanted in the S&P 500 over everything else is Palantir does sell to a lot of big companies, right? And a lot of big government organizations. And it is an extra boost, in my opinion, to your sales repertoire when you can go ahead and say you're an S&P 500 company, right? It's kind of like the Holy Grail, right? I mean, some people would look at like the Fortune list, Fortune 500. The S&P 500, if you're an S&P 500 company, like you're seen as like the creme de la creme, right? You're the best of the best. Like you've got products and services in the market that are special, truly special, right? And so it just gives you an extra kind of leg up when it comes to sales. And so here's a question for you. Does S&P 500 inclusion help only the stock, or does it help the stock and the fundamentals of the company? My personal belief is by getting the S&P 500, It's mainly going to help with the stock, but I believe it actually will help the fundamentals of the company. Because I believe now that they have this kind of branding there, I do believe that there is real power in being an S&P 500 company when you're selling to other big companies, right? Or smaller companies that are in the S&P 500. You're looked at like, wow, you're really like the creme de la creme. Your products and services are special. Because usually you only get an S&P 500 if you're truly a special company, right? So that's a little food for thought in regards to that. Ed Jordan Denny. Ultra dovish cuts may be off the table after CPI report. What?
Great to see you again.
I don't know if I agree with this.
Thank you.
I know you've written last few days about expected chop in September. You wrote about China last night. But I wonder, does this core CPI print, should it be considered a threat to the doves?
Well, I think to the extent that there was some heightened expectations that there would be a 50 basis point cut in the Fed funds rate next week, which would be sort of the ultra dovish position. I think that's off the table now, and I think you're more likely to see 25 basis points. I shouldn't say it's off the table. I really don't know what the thinking of the Fed is, other than that they've certainly pivoted away from being concerned about inflation to being more concerned about keeping the unemployment rate down. But the data today was pretty good. Take out rent, and the headline inflation rate was 1.2%. We've been talking about getting to this level for a few years. We thought that it would come down. So things are going right on inflation, and I think the surprise is going to be that the economy is more resilient than people are thinking.
If that's true,
if you're wondering why was the stock market down so much earlier this morning, right, and why did it come back? My belief is the early drop, because here's the thing, before I went to bed last night, futures were already dropping big after what happened last night, the debate, right? And, the consensus certainly was Harris won the debate. And so being that the consensus was Harris won the debate, people could view that as, her odds of winning the election go up in that sort of situation, right? And so therefore the market has to price that in. The market doesn't necessarily love some of her tax policies and those sorts of things, right? We know about that. And some of the changes she wants there. And so the market was kind of pricing that in. But then you got CPI, and ultimately, do I think the market took this CPI as a positive? My belief is yes. I think, CPI coming in at 2.5, I believe the market liked this CPI report. I believe this was a CPI report that, months ago I called the dragon been slayed, right, in regards to inflation. This was a sort of CPI report that if you were on the side, if you were still uncertain about inflation, right, this has to be the CPI report that just slays the dragon once and for all in your mind, right? If you're still worried about inflation at this point in time, I don't know what to tell you. Look at what's going on in the commodities market. Look where these commodities have been heading the past year, right? Look what you're seeing in all this different data. If you don't like the government data, go look at Trueflation numbers, right? There's just, I think if you are still in the camp of inflation's this big problem, the Fed has to worry about that, I just think you're way off sides in regards to this. That was the game of a year ago, 2 years ago. We're on a new game now, and the Fed's number one focus and attention really has to be on the economy and the employment market now at this point in time.
what did you make of the bank commentary yesterday, and did that move the conversation meaningfully?
Well, Carl, I only listened to what supported my story. The fellow from Bank of America, Brian Moynihan, certainly was very positive on that. Jamie Dimon's been kind of pessimistic about the outlook since May of 2022. He's been a long-time pessimist. But I think, look, you can't really generalize about the consumer. We clearly have consumers that are struggling, that maybe have maxed out on their credit cards. But then we also have plenty of other consumers, particularly the baby boomers. Let's say there's 70 million of them that have $78 trillion worth of assets. A lot of them are retiring, and that's why the savings rate's down. And they're spending money. There's no doubt about it. They don't have mortgages. True. They don't have to pay for college education. So I think it's a mixed story on the consumer. And when you kind of add it all together.
And that Social Security's been getting bumped up, right, with all this inflation. So that's true.
It still looks pretty good. As you know, the Atlanta Fed estimate for consumption during the third quarter, real consumption, is 3.5%. That's gangbusters.
I'm thinking of all the big things you've written about, Ed, in recent quarters, namely the generational transfer of wealth, right, which you've talked about, the the productivity progress we're making, and the export of deflation out of China. Shouldn't those all be considered positives for the U.S. economy?
Absolutely. I think the U.S. economy is the big winner here. You know, when the Fed started raising interest rates in 2022 through 2023, it was logical to believe that tightening of monetary policy would cause a recession. And the reality is there was a recession. It was just happened to be in China. They have a property depression and they're exporting deflation. And that's one of the reasons that our CPI inflation rate has come down so rapidly, is because durable goods inflation, and we import a lot from China in that regard, that's come down into deflation again. So, yeah, absolutely. All those things are good for the economy.
You might say, why are some of these solar stocks bouncing big here today? Well, you know why. Come on, put the pieces together. The debate last night, right? That's why you're seeing First Solar up big here today. That's why you're seeing Enphase up big here today.
And positive for the stock market.
Ed, did you read the Beige Book? I mean, more districts contracting. I mean, also, it does jibe with some of the recent commentary. I was looking at Dave & Buster's today, not necessarily that that's the most indicative of the economy, but tough kind of consumer environment. Many others are feeling the pressure. Petco CFO, choiceful and value. If you listen to companies and look at the anecdotes, it's full of weakness and softness on the labor market, on the consumer.
100%, and that's why the Fed needs to get moving here. 50 basis points. You know, everybody's acting like, oh, they got all this time in the world. They got to get moving, man. They got to get moving. 50.
A very good point. It just seems that a lot of the survey sort of data has been more pessimistic than the actual data, and it's the actual data that matters. I mean, real GDP is running at 2.5%.
The actual data, Ed Denny, in all due respect, sir. When you say the actual data, you talking about the government numbers that we know they get screwed up all the time and they manipulate? Come on, Ed. I don't know.
During the current quarter, and that's even with July being affected by the weather. And as I said before, the consumer is running, as the run rate is 3.5% in the third quarter. So I think that for some reason the surveys are picking up a more pessimistic tone than the data is actually reflecting. Initial unemployment claims remain extremely low. Everybody kind of got bummed out by the payroll employment report for August, but actually the work week rose, and so aggregate hours worked is an all-time record high. And I think retail sales are going to surprise to the upside, as will personal income, because not only did we have more people working in aggregate in terms of hours, we also had a nice increase in wages. And to the point you made, Sarah, about real wages, they're absolutely up. And Lael Brenner was absolutely correct in saying that can only happen with productivity doing well.
We'll see what retail sales brings us, Ed. Interesting to get your forecast on that. Hopefully talk around that as well. Good to see you.
Yeah, so the bottom line is right now, right, you look forward to getting into Mike Wilson. I hadn't heard Mike Wilson talk in a while. This is going to be interesting here. Mr. was very, very bearish over the last couple of years, but I think he might be flipping. So here's the deal, okay? CPI 2.5. Fed funds rate, where's that at? 5.25 to 5.5. So we have about 300 basis points, right? 300 basis points of too much, just the Fed's way too tight. The Fed's way too tight right now. 300 basis points too tight? That's an extreme amount. In a perfect world, you would say the Fed should lower interest rates 300 basis points. They should lower by 3 full percentage points. Now, right, they're not going to do that because that causes all types of markets to gyrate. That would cause crazy volatility in the bond market and treasury markets and all those sorts of things. So they wouldn't do that, right? They're going to have to go over a course of 12 months or whatever, right, or 18 months. But they have to get moving here. Do 50s, 50s, 50s. Why not? Like if I could talk to Jerome Powell right now, and I could talk to all those Fed people, and they let me speak up at the table for 2 minutes, I say, why not just go 50s nonstop for the next several months? What are you scared about? Inflation? That's not an issue. We know that's not an issue. CPI is at 2.5. Commodities market's dead for the past year. It's not doing a dang thing. So that means that bodes very well for next year's inflation numbers, right? What's the deal here, right? We know the employment picture is getting softer. That's clear as day, right? We know companies, for the most part, have okay things to say or bad things to say, right? You're getting all the data to really kind of justify, like, we got to get moving here, man. To go 25 and then a 25, oh my gosh, man. It's going to take us 100 years to get these Fed funds rate down. And the longer that takes, the more damage you could cause to the economy, and the more you're going to end up in a huge, huge situation. And then it's going to get ugly, because then the Fed's going to have to come in, try to backstop everything. The money print that's going to go on, right? It's ugly. So just get ahead of that. You know, they go 50s right off the bat here. You know, 50 to end the year, 100 basis points, and then keep it moving in 2025. Mike Wilson on the Fed, inflation, artificial intelligence.
Early Eastern time for clues about how much the Fed will cut rates this time next week. Concerns are lingering over whether the central bank has waited too long. Mike Wilson of Morgan Stanley writing, until the bond market starts to believe the Fed is no longer behind the curve, growth data reverses course and improves materially, or additional policy stimulus is introduced, it will be difficult for equity markets to trade with a more risk-on tone. Mike is with us around the table. Mike, good morning to you, sir.
Good morning. How are you?
I want to pick up on that quote, and we're doing great. I want to pick up on a line that you're focused on. The difference between Fed funds and the front end of the yield curve, Fed funds in a 2-year, and that quote, how important is that?
Well, that's a signal that we're getting from the bond market. The bond market has historically been a pretty good indicator of where the Fed is relative to kind of what they need to be doing. And we saw this, by the way, on the upside, too, right? In the 2021 timeframe, the 2-year got ahead on the upside. So it's the same picture, just on the other side. And you know, people complain, they don't complain, they say, well, look, the stock market is behaving fine, but that's not true. Internally, once again, you know, defensive stocks are really doing extremely well. So I think the stock market is taking its cues from what the bond market is saying. It's not saying hard landing yet. What it's saying is that growth has continued to disappoint. So since April, and we've been on this program many times since then, I would say that the data has been distinguishably negative in terms of growth data. Also, the labor data has been much worse. So how has the equity market dealt with that? Well, it's pivoted from what I call quality growth to quality defensives. We made that pivot in May, and that's classic late cycle behavior. So I think everything kind of sinks. It's just we're waiting for the, you know, like, can somebody give us the keys to the test? You know, the cliff notes, whatever it is. Like, how's this going to end? And we don't know.
But the market's ask you, don't you? I'm going to ask you. Basically, you've said we need one of two things. Either the Fed cuts aggressively, or the labour market starts to improve, and improve quickly.
That's right.
For equity markets to perform well. So have you got a base case? Is it one or the other? Do we get one or the other?
Well, what I would say is that the Fed could get ahead of the curve if they decide, but the problem, they're constrained. Okay, they're constrained by two things. Not inflation, by the way. Inflation's over, as far as I'm concerned. Inflation, they
Thank you, Mike Wilson. Thank you, Mike Wilson. We might not agree on a lot last year or two, but hey, we definitely agree on that.
What the issue is now is the currency market. If they come in and start cutting aggressively, the yen-dollar relationship is going to create some stress. So they got to be careful with that. The other thing I would throw out there is, we've looked at this, when the Fed starts a cutting cycle with 50 basis points as opposed to 25, the chance of a soft landing goes down materially. And they know this. They know this data. They don't want to signal that. So they're in a tough spot. The Fed's in a difficult spot. They've done a good job of trying to navigate this, you know, challenging, different environment that we've been in for the last several years. But now the markets are pressing them. And so next week, I don't really care what they do next week. What I care about is how the markets react. How do the markets behave after they've done what they're going to do, 25 probably, and then what do they say in the press conference?
The vibes, whether they actually work for the market or
That's
not.
right.
I'm curious, though, before we go into quality growth and quality defensive and what that actually means, you said something about the currency differential. Are there certain target levels that you see sort of unwinding some of the longs that still remain out there? Do you have a sense of just how disruptive the ongoing long trade?
So, I mean, yeah, you can say there's risk to doing a 50 right off the bat. There's so much risk to doing a 25, including to Jerome Powell's legacy. If they could do 25 and we get a big recession, everybody is going to be looking at that and saying, dude, you had all the signs. Inflation was dead. The labor market was starting to face weakening. You had a lot of companies complaining about their businesses weren't strong. And you went 25 off the go when there was a 300 basis point gap between Fed funds and where CPI was? Ooh, boy, that's going to be rough, right? That's going to make the Fed look really bad. At least if they get out here and start it with a 50 right off the bat, then you could say, okay, the Fed's serious about getting these rates lower. 25 is, it's just signaling like, yeah, we've got all the time in the world. And then all of a sudden, it proves not to be right. And then you look really wrong.
Dollar really will be potentially down the road.
Yeah, I don't have a specific level, but I do feel like they're trying to defend this low 140s level between yen dollar, so call it 142. If we start to, 130-ish, 138, 139, I think that could cause some stress in other markets.
Meanwhile, you talk about shifting from quality growth to quality defensive. I've struggled with these monikers quite a bit, simply because what does defensive, what does growth mean? Where does NVIDIA fit into this? Where does the tech trade go, given the fact that people have gotten an AI trade that is so inflated in terms of expectations and timing? What does that mean to you, quality defensive?
Defensives are your classic defensive sectors, whether it's utilities, staples, healthcare, things that are positively correlated to bonds. Okay, they did not trade well, by the way, up until sort of April. It was really the quality growth stocks. Now, the other thing that's happened is the AI dream has taken, a little bit of that luster has come off. And I really gauge that by what semiconductors are doing. It's not just NVIDIA, it's semiconductors writ large. And a lot of those stocks have really come off. And that makes sense to me. We just got overcooked on the whole AI theme. It doesn't mean it's over. Sure. We've written about this extensively. We're not believers that this is going to change productivity materially in the short term. That's a long-term story. And everything kind of got bid up on that. So with that theme now gone, the market is looking for a new theme. On a growth side, there isn't one. So what it does is it hunkers down into defensive, high-quality assets until we get the next thing. Whether that's a bad outcome or a positive outcome, they're going to hide out in these areas.
Mike, you say inflation's over. We do have CPI data, though, today. So I'm curious to know, how do you think the market would trade if we get, say, a hotter print? Say, is it too volatile? Or softer print? Would the market start pricing in 50? Or look at a softer print and say, wow, we are cooling down faster than even the Fed was expecting, and bad news really is bad news.
Yeah, well, when I said inflation is over, I mean the rate of change on inflation is over, and it's kind of over for equity markets, and quite frankly, it's over for the Fed. Where inflation is not over is the price level. Right? The price level is absolutely squeezing the heck out of businesses and consumers, and so it's like a vice. And so I don't think inflation is over in that regard, but what I would say is that a hot number, I think is probably pretty bad for the stock market today. I'm not expecting that, but if we got a hot number today, then all of a sudden the Fed is going to stay behind the curve. They're kind of stuck. If we get a really soft number, then we go back to our old thesis, which is pricing power is gone. Okay, so we kind of need to thread the needle here a little bit too. I mean, break evens are at 2% now. Break even. So what are we talking about? We're already at 2%, and it's not like these things stop on a dime. They have there's a risk that we undershoot on the downside. That's good for bonds. And it's bad for stocks typically. And by the way, that's how the stock market, that's how the markets are trading. So I think the markets already understand all of this. Once again, they're going to do something next week to try and manage the situation. 25 is what we think, and they'll signal for more 25s, not 50s. And then what do they do with the balance sheet? I think that's probably the bigger wild card. Do they talk more aggressively about ending QT more quickly? Do they find other provisions to provide liquidity? That's the bull case, in my view. That's where we could be surprised on the upside. Is there more liquidity coming into the system from other sources?
And after next week,
because the Fed has been reducing their balance sheet considerably for really, honestly, it's been about 2 years now at this point in time or so. They've brought it down by, last time I checked, it was at least a couple $1 trillion.
Everyone's going to really be focused on the U.S. election. Goldman Sachs, RBC, they talk about how earnings will be much higher potentially under a Trump administration if he gets his tax cut plan, rather than Harris, who's calling for 28%. How do you view next year earnings growth based on these two proposals?
Assuming that the economy is in a soft landing, okay, that the Fed hasn't overstayed its welcome, and by the way, I think that risk is still on the table. We're in the soft landing camp, but that to me is way more important than the outcome of this election in the next 6 to 12 months. So let's assume we're in a soft landing. Our view is the same. We think that basically Trump is kind of pro-growth, kind of bad for bonds, good for stocks, okay? And that's how we would look at it. And by the way, last night when the debate was going on...
Wait, say that again?
Election in the next 6 to 12 months. So let's assume we're in a soft landing. Our view is the same. We think that basically Trump is kind of pro-growth, kind of bad for bonds, good for stocks. Okay. And that's how we would look at it. And by the way, last night when the debate was going on... Which
means exactly the opposite would happen.
And the betting markets kind of went in favor of Harris, and the stock market futures kind of traded up a little bit. Okay. But I do think the stock market is more pro-Trump. I mean, the stock market has traded better when his odds go up and vice versa.
So bonds are good under Harris and stocks are bad under Harris?
In theory. I mean, at the margin, I would say that's the setup. And the reason being is really taxes. Taxes is the one thing, and that requires some congressional support too. But to me, that's the big issue, not tariffs so much. Both administrations have tariffed. And then immigration, I think both parties are going to have to deal with that in some way. So taxes is the issue. Obviously, Trump is talking about cutting. Harris is talking about raising them. That's bad for stocks, good for bonds.
Wanted to ask you this question. I want to squeeze it in.
So Trump isn't necessarily great for the market, and I think that's what investors got to understand. People could make a argument that Trump's great for the economy, right, or for jobs, or for the average person, things like that. Like, if you want to make that argument, you can. But I can tell you, as somebody that experienced the Trump presidency in the market the full time with a lot of money invested, right, he's not always good for the market. There's a lot of different reasons for that. He's very volatile. We all know that, right? And so he can, flip and change his mind on something real quick, and it cause a lot of volatility in the market, right? He can do tariffs, trade wars, those sorts of things, cause a lot of disruptions in regards to a lot of big global companies, and that creates volatility in regards to their stock prices, in regards to their business models. It creates disruptions and those sorts of things. And so you got to understand, like, in Trump's first term, he got the 15 percentage point drop in corporate tax rates. That's not coming if he gets a second term. That's not coming. He's not going to be able to even touch corporate taxes this time around. So you got to understand, 14 percentage points of Trump's gains in the stock market when he was presidency was just from getting at least 14 percentage points was just from getting corporate taxes down from 35% to 21%. That's not happening again, right? And so when I look out there, I know a lot of people are like really excited. They think the stock market's going to boom under Trump. And I'm just here to tell you, like, don't get too excited about that, okay? As a lot of people get too sad and disappointed over certain presidents, they think, oh, the stock market's going to do horrible. Like, a lot of people could have thought the stock market would be trash under Biden, right? Stock market's done pretty dang good under him, right? And so a lot of people, people run to these conclusions with just not understanding like what's actually going on underneath the market and the surface in regards to these sorts of situations. So, don't get too bullish. Don't get too bearish on who's going to be president or who's not going to be president.
Brian, Lisa was knocking on the door. Are utilities actually defensive? They're up like 20% this year.
The issue is people get so emotional when it comes to politics, right? I'm able to not get emotional because I don't vote. But so many other people, they vote, so they get so emotionally attached, and it's like rooting for their football team or their basketball team, and they think like we're going to win every game, right? And they think the other team's the devil, and they're the worst, right? And in that emotion then overflows into their opinion on how they're feeling about investing in the stock market and all sorts of things. And dude, anytime you are wrapping up your emotions with stock market, or anytime you're even thinking about like this president's going to be good or bad, you're already lost in regards to stock market. I can promise you. As somebody that's been doing this 16 years, I think that was one of the points I made in that great video I released last week on the main channel. What was it called? 16 years of stock market advice in 52 minutes, right? I think it was one of the points. Like, if you're lost if you're making your investment decisions based upon who might be president or who might not be president, or who's going to be president and who's not going to be president. Like, trust me, it doesn't work the way you think it works. Trust me.
Feels like everyone's getting whatever they want from utilities. It's defensive. It's attached to AI. What are utilities?
So this is a very interesting question. So, we agree. I mean, we don't think we were one of the first ones to talk about utilities as an AI beneficiary back in February, March. I think that's probably gotten a little overdone, to be honest. But now utilities are definitely trading with the bond market. So the defensive properties of utilities are, I think, dominating their performance in the near term. Here's the interesting thing about utilities. Their balance sheets are not great. Okay, so you got to be really careful with utilities. If it's going to be a hard landing, these things are going to start trading really poorly. So I would caution listeners, if utilities start trading really poorly and the stock market's not ripping, that's a bad sign. That would be a sign that, we are actually getting closer to potentially hard landing risks. That hasn't happened yet. But if you look at things like low volatility parts of the stock market or defensive, they've gone almost parabolic. And if they start to sell off hard without a stock market rally, then I get concerned about hard landing risks. That's not the case today.
Interesting. Already Mike Wilson. Mike Wilson's a little bit more playing it. I would still say after watching that, do I still feel like Mike Wilson's more of a bear than a bull? I would say yes. I feel like he's still more on the bearish side than the bullish side. But I will say he's much more even keel compared to how he was certainly in 2022, 2023 when I would react to his videos. Fed will cut rates by 25 basis points next week. Mr. The Big Short here, Steve Eisman.
Everything with the Big Short long ahead of time, was able to see what was happening. Steve, we come to you on a lot of issues because you have been so incredibly right on some of the bets you've made. Where do you think things stand right now for the financials? Because it does feel like a little bit of an inflection point. We heard from Bank of America yesterday saying that things look pretty good, but you also heard from Jamie Dimon saying that there could be some concerns out there on the broader spectrum. You haven't been worried about the banks in a while. You still feel that way?
From a systemic perspective?
From a systemic perspective, you have not been buying banks, but you have not been...
From a systemic perspective, I lose absolutely no sleep about the banks. They're extremely well capitalized. They're far better run. They understand their risk better than they ever have. And there's nothing to worry about with respect to the banks.
So, I will say I trust Steve Eisman's judgment immensely in regards to a subject like the banks. If there's one man who really understands, who's not technically a banker, right, but really understands the business and the books of these guys, if Steve Eisman says there's no issues with the banks, I'll take him at his word of that, right? And when I look at the banks, I would say for the most part, no. Even in a recession, sure, they'd all get hit, but there's not like that sort of out of control nature to them like there was maybe in 07, 08, 09, right? In kind of what we went through in regards to that. So, yeah, I think that's fair.
To invest them is another story.
Yeah, you didn't like them a year ago.
That's a good point. To invest in them is a different story.
Feeling about them now?
I don't think there's a story with respect to the banks. I mean, I find them to be trading vehicles. People use them as a means to express how they feel about the economy. You know, right now, what's facing the banks is the Fed's going to cut rates, and that's going to hurt net interest margins, which is what J.P. Morgan said yesterday. Credit quality is getting slightly worse on the margin, which is what Allies said, and people got hysterical and took the stock down over 20%. But there's no story with respect to the banks right now.
If it's a trading vehicle and J.P. Morgan shares were down $11 on concerns about net interest income, is that an opportunity to buy in on a trading moment?
You know, this is what I don't do. I don't trade. So if there's a long-term story, I'll own it. I don't think there's great long-term stories generally in the financial sector. There are a few, things here and there, like you can own Visa long-term because it's a great business.
PayPal,
but there's no great story in the banks right now, one way or the other.
And what do you anticipate from the Fed next week? If it doesn't matter for financials, it does matter beyond that.
I actually think there's reality and there's perception. And I think people spend a lot of time trying to figure out what the Fed's going to do. My guess is the Fed will cut 25 basis points, and that'll be fine. That it's important on the margin. It's certainly important on Fed Day. I don't think it's really that important for long-term investors.
We were talking in the commercial break ahead of time about your prediction that Donald Trump was going to win. You came out with that prediction a while ago.
I said that 100% certainty.
100% certainty. It was days before Joe Biden stepped out of the race.
So in my own defense, I will say that I made that prediction before the first debate between Trump and Biden. I felt very strongly about it. That prediction was looking really good after the debate, and I withdraw it. I did not anticipate that a sitting president of the United States was going to drop out of the race. It's never happened before. I think the election is a toss-up. I mean, if I had to stake my life on it, I would say still probably Trump wins because he'll win Pennsylvania. But it's too hard to tell.
Yeah. That's exactly what I would say. It's really, really dang close. And that's why it's always dangerous to assume, you got something in the bag, because then something happens that you never saw coming, right? And it's just like, what?
We're going to follow up. You had a lot of questions.
And I owe you an apology. Because the last time I was on...
I have no idea where you're going. I'm scared.
I know you don't. The last time I was on, you pressed me about the fact that the low-end consumer is having problems, and I gave you very short shrift about it because I didn't think it was important with respect to the market.
Okay, let me just think back on times you've blown me off. No, I can't narrow it down.
It was the last time I was here.
No, I'm kidding. No, I remember that. Yeah,
and,
but you have a great.
And the reason why I gave you short shrift because nobody's asked me about the low-end consumer since 2008.
They should have extended that. I was actually interested to see where he was going to take that in regards to low-end consumers. No one's asked me about that since 2008. Where was he going with that, man? Like, why'd they shut it off right there? Like, that was about to get really, really intriguing. I think we were going to get a better view into his mind there and maybe put some pieces together. That's disappointing, man. That's disappointing. I would have loved to see that play out and see where that was going to go. They had a good moment there, man, but they lost it. All right, guys, appreciate you joining me as always. Thanks so much for being here. If you want my brand new workshop I made for you guys last week, stocks to buy now for 2025, how to position your portfolio now for 2025. Check out the pinned comment down there. Enter in to get that workshop via email or text. We'll send it on over. Much love and have a great day.